Hey everybody, Smart Silver Stacker here. There is a serious risk that the German economy and also the broader European economy as a whole may be plunged into a deep recession in the very near future. And this is the result of a diminished flow of Russian natural gas on which these economies are heavily dependent. So far, the flow of gas has only been diminished, not entirely cut off, although that may be occurring in the future. But still, even with these reduced gas flows, we are getting some inflation numbers out of Germany, which can only be described as shocking. And that is what we're going to talk about in today's video. So let's get to it. Okay, so here's a headline over at Kitco News, and this was originally from Reuters. The headline is Germany risks recession as Russian gas crisis deepens. And Russia has diminished the flow of natural gas to Germany through the Nord Stream pipeline by about 60%. And as a result of this, there are rising prices pretty much across the board in Germany. And we're going to talk about some of the inflation numbers that we just got out of Germany in just a moment. But first, I want to point out that the German BDI Industry Association slashed its economic growth forecast for 2022 on Tuesday, so that's today, to 1.5%, revising it down from 3.5% expected before the war. And it said a halt in Russian gas deliveries would make recession inevitable. And so far, the Russians have not entirely cut off the gas supply to Germany, but the trend so far since this war broke out has been for increasingly diminished supplies. And a number of countries have already been cut off: Poland, Bulgaria, Finland. And that list just continues to grow. And now Germany, which is one of the most heavily dependent countries in Europe on Russian gas, is really starting to suffer as the flow through the Nord Stream pipeline, that's one of the main pipelines, is being cut by more than half. We're getting these inflation numbers out of Germany. This just came out yesterday. The producer price inflation for May, which is 33.6%. So producer prices in Germany have increased by 33.6%, a full third rise in prices. And this doesn't mean that the consumer inflation has moved up that high yet. Typically, a move up like this in the cost to producers would be something that would precede high consumer inflation. Now, consumer inflation in Germany is already quite high. The current inflation rate of 7.9% is already higher than in the winter of 1973 and 1974, according to this article from the English language Munich Eye newspaper. But 33.6% is an absolutely astronomical move up in the cost to producers, and you can guarantee that with producer prices moving up that much, consumer prices are not going to be far behind. And pretty soon, 7.9% inflation is going to seem like a pretty good deal compared to what we have coming down the pipeline. And, should this situation between Russia and the EU continue to devolve, and it looks like it is. If you saw that video I put out yesterday about Lithuania and Kaliningrad, both sides continue to up the ante and escalate this economic warfare, and there's a real possibility that it could turn into hot warfare very soon. And if that happens, it's almost guaranteed that the flows of Russian gas from east to west will be cut off, possibly forever. And Europe is really going to struggle to find a replacement. One of the things we've seen is that Russia is sending much more oil and petroleum to China and India, and they are also working on pipelines right now to divert gas flows that traditionally have gone to Europe to Asian markets. And so, this is a realignment of the world economic order. Clearly, this is something I believe that China and Russia have been planning for some time with their plans for de-dollarization. I've covered that in previous videos. If you haven't seen those, go check those out. The consequences of this are going to be very serious for consumers in the West. These rising energy prices in Germany, they're not going to be isolated to Europe. They are eventually going to spread to the US as well as we begin exporting more energy, and there is some arbitrage in those energy markets. And it's just time to get prepared, get prepared for rising costs across the board. There are going to be a number of factors driving prices up both in Europe and throughout the rest of the West for the remainder of this year and possibly in years to come. Not only has there been a lot of fiat currency created in the US and in Europe, but also now there is a serious supply shortage of a number of goods, particularly related to energy. And as we know, energy tends to bleed over into other areas of the economy, as it's involved in just about everything from agriculture to transportation to manufacturing. Everything gets touched by these rising energy prices. Consumers are really going to start to feel the pain. So get prepared however you can. If you need stuff, physical, tangible stuff, and you can afford it, buy it now because it's not getting any cheaper anytime soon. And if you've got some disposable income, if you've got some fiat currency that you want to park somewhere safe, I think it would be a good time to start taking a look at precious metals, gold and silver, traditional inflation hedges that have never gone to zero and tend to rise quite a bit in commodity bull markets, which I believe we are entering into a historically significant commodity bull market. So let me know what you think in the comments down below. Thank you all very much for watching, and I will catch you next time. Smart Silver Stacker, out.